So this is my third office hours video. We're going to cover chapter 3 with some highlights and insights. Many of my students have already seen parts of this presentation in the weekly class. This first slide is basically a summary of what we put together in week 2, where we have associated the 4 financial statements as sources of information to help assess the 2 main aspects of a business entity's financial position and financial performance. What we can see from this slide is basically the 2 statements that have information useful to assessing financial performance are the income statement and the statement of cash flows. The income statement contains 2 of the 5 financial statement elements that you're responsible to understand. Those are revenues and expenses. And the difference between them is what generates net income. And of course, income or profit is one of the 2 main business performance criteria that key stakeholders use to assess financial performance. The other one is cash flows. And we have a separate statement called the statement of cash flows strictly for that purpose. In order to evaluate and assess financial position, the 2 statements that contain information for that purpose are the statement of financial position, also called the balance sheet, and the supporting statement of retained earnings, which is just a continuity schedule that helps to prepare the ending balance of retained earnings for presentation as one of the 2 major components of equities. The balance sheet has 3 of the 5 financial statement elements that you must understand. Those are assets, liabilities, and equities. This slide also illustrates the connection among the statements and effectively provides the order in which the statements must be prepared. So typically we prepare the income statement first. It generates net income as its bottom line. That bottom line feeds into the statement of retained earnings, which consists of a beginning balance, an addition of net income, a deduction of any dividends distributed to the owners to calculate the ending balance of retained earnings, and that feeds into the balance sheet. Once all of the 3 statements that are within this fence have been prepared by the accounting system, then the accountants prepare the statement of cash flows based on changes in those other financial statements. And the bottom line of the statement of cash flows is the ending cash balance for the year, which must agree with the cash balance that's presented on the balance sheet. As I have done in the previous 2 chapters presentations, I have a schedule of what you must know to be able to pass the various quizzes and exams in this course. These are recommended by the faculty who have taught the course in the past and prepared the textbook. There are basically 5 things you must know in chapter 3. The first is being able to identify what accounts are affected by transactions and which accounts belong to which financial statement elements. Secondly, you need to be able to analyze and process transactions. That starts by understanding the difference between a transaction and an event. A transaction has accounting significance and gets recorded. An event does not. If you are presented on a quiz with a description of an activity that represents an event, you should signify your knowledge that it has no accounting significance by choosing a quiz option that no entry is required. So to qualify as a transaction, an activity or event needs to meet 3 definitional criteria. It needs to be an exchange where 2 items are exchanged. That will be something given up and something received. It needs to be measurable, which is indicated by an amount being provided to you or one that you can calculate. And it needs to be realized, or in other words, it needs to have actually occurred. There are 2 sets of questions that you can ask to help you identify a transaction. One is, what are the items that were exchanged? What was given up and what was received? And then there are what's called the enhancing questions, which helps you, knowing those two things that have been exchanged, associate them with financial statement elements. And so, for example, sorry, we just had some guests arise, and I just wanted to let the sound diminish. All right, so the example I was going to provide is that if one of the financial statement elements that we need to identify happens to be a revenue, then the key question that you'll have to ask yourself to see if it's satisfied is whether or not revenue was earned. In other words, did the business entity provide some form of performance, such as delivering a good or providing a service? If we're talking about expenses, you can ask yourself the question, was something consumed or used? If you're trying to identify whether it's an asset, liability, or an asset or liability, then each of those financial statement elements has itself 3 criteria, and you should review your textbook to identify what those are. So when you know what kind of financial statement element, the next thing in processing a transaction, after you've done that analysis, is to associate or attach a name for an account as a bin where you collect the monetary amounts associated with the transaction. And if you remember from the exercises we did in class, in order to keep the balance sheet in balance, or the basic accounting equation, which represents the balance sheet in balance, the left side of the equation has to equal the right side. And that means that we have to account for the 2 sides of the transaction. So that's what gives rise to the double entry system of recording in accounting systems. So just remember that in any transaction, there are always 2 parts that you're going to have to record. The third item is for you to understand the notion of capitalization. When a business incurs a cost, it's either going to be an asset or an expense. And if you decide in your analysis that it's an asset, primarily because it has probable future economic benefits the entity can realize by controlling or owning the asset, then the process of accounting for that cost as an asset is called capitalization. If it doesn't meet the criteria for an asset, then we would expense the cost. In the case of capitalization, creating an asset, that cost will end up on the balance sheet. If it's an expense, of course, it will end up on the income statement. The fourth item has to do with the concept of recognition. And recognition is the term accountants use to decide whether to record the 2 sides of a transaction in the accounts or not. And I'll discuss that in greater detail on a subsequent slide. But the primary criteria for recognizing revenues is when they're earned. And the primary criterion for recognizing expenses is when they are incurred. These recognitions are made irrespective of whether there's any movement of cash. In other words, whether you've been paid for your revenue or whether you pay for your expenses. So the key criteria is not when cash is paid or received, but rather when the revenue is earned or the expense is incurred. Lastly, all of what we've been talking about in terms of transaction analysis and processing are activities that lead up to the creation of financial statements so that we can use the information therein to go back to kind of slide 1, which is to assess financial performance and financial position. The importance of assessing financial performance is to help the key stakeholders realize what they're expecting in terms of the company generating profit and cash flow and having enough to provide returns to the key stakeholders. The idea of financial position is to assess whether the company is healthy enough from a financial perspective to be able to carry on business in the foreseeable future in order to continue to exhibit desirable and acceptable financial performance. Now, in addition to those requirements for the course, I also make some suggestions to deepen your understanding. And I essentially have two in chapter 3. The first is how to create financial statements from accounts. And I will give you some examples of how to do that. It really is a process of knowing which accounts to associate with financial statement elements. That's step 1. And step 2 is knowing which financial statement elements belong on which financial statements. If you can do that, then you can take a list of accounts and basically put them into the financial statements, total them up, and you'll have something that is available to you to make these assessments of financial performance and financial position. To be able to create the financial statements from accounts, you need to know what accounts are associated with the financial statement elements and what elements are associated with the statements. I think I just said that. The second thing is, how do we analyze and interpret the financial statements? In other words, how do we assess financial performance and financial position? So this starts by knowing the business performance criteria, which I have presented in my video on chapter 1. Once we know those criteria, we can use particular business performance criteria in assessing financial performance. Those are primarily growth in revenues, profits, and cash flows. And to assess financial position, we will appeal to the business performance criteria called liquidity, solvency, and also cash balances. I'll define liquidity and solvency in a future presentation. So once we have put our accounts into a financial statement, we can ask some simple questions like, did the business entity generate a profit? Did they grow their revenues? Did they have a positive cash flow from operations? And those, a yes answer to any of those questions would be favorable. But how favorable is a matter of degree, and we can't necessarily grade it or attach a degree unless we are comparing financial performance and position to something else. And those something else's that we can compare to include the business entity's performance or position in a previous period, their budgeted budgeted financial performance and financial position, or a comparison with competitors or the industry at large. So I just want to check and see if there's anybody waiting to come into this presentation. All right, so let's look at these accounts first of all. This chart is the result of reading the textbook, and every time there is a description of a particular account name, I have made a note of which financial statement element, assets, liabilities, equities, revenues, or expenses, that account tends to be associated with in common financial statements. So for example, in liabilities on the balance sheet, we often list the liabilities such as accounts payable to our vendors and suppliers, salaries, wages, and benefits payable to our employees, customer deposits, where we've received payment from customers before we've actually earned the revenue. Those tend to be called unearned revenue or deferred revenue, and they will show up in the liabilities section of the balance sheet. Unearned revenue, since not earned, is not revenue and doesn't belong on the income statement. Instead, the business entity has an obligation to perform the service or deliver the product in the future, and that obligation makes it a liability. Okay, so if you look at for any of these columns, here's a list of the general types of accounts that you will find associated with any of those financial statement elements. Now, here, for example, is a sample balance sheet, and you'll see a list of the accounts on the asset side added up for total assets. You'll also see a list of the various accounts associated with liabilities and the two principal components of owner's equity. All right. So the more frequently you look at these statements, the more you'll remember which accounts commonly appear on the particular statements. Here's an example of an income statement. I like to keep the income statements at a summary level. So the marketing and selling expenses, for example, is an aggregate of all kinds of other accounts that might go into them. If we go back a couple of slides to the account list, you'll see under marketing and selling expenses, we might have separate accounts to track our spending on advertising, website hosting and maintenance, promotion, trade discounts, and things like that. But if we listed all the accounts on the income statement, the statement itself would become too lengthy. So it's common practice to summarize similar types of accounts into a general caption. And if you were to look online using a website such as finance.yahoo.com, pick one of your favorite companies like Apple or Netflix, you will find their statements look just like this for the most part, where they have sales, the cost of the sales, and a limited number of general operating expense categories. Okay, they all look like this. Other types of expenses that you may have seen in some of the textbook examples include depreciation, interest on our debt, and income taxes. And now let's talk a little bit about recognition, the factors that go into recognizing revenues and expenses. When do revenues get recognized or recorded? The primary criteria is called performance by the business entity. That means for services, they need to have been rendered, or for goods, they need to have been delivered. It's insufficient to simply manufacture the goods and have them sitting on their shelf because the customer, from the customer's perspective, the business entity has not fulfilled its obligation to actually provide the goods to the customer. And one of the things I can say in terms of guidance is, remember the example I used in class where someone is, painting a customer's house or fence or doors, and they can feel like they've earned something, even if the customer's away and doesn't pay them. And it's that feeling of satisfaction that you have completed the performance of your obligation to provide the good or service. That's what triggers the accountant's recording the earning of revenue. Of course, that is one side of the exchange, and the other side is either going to be you got paid and received cash. If you didn't, you're going to receive a promise to pay in the future. When do expenses get recognized in the financial statements? Well, the criteria for expenses is when they are incurred. And there are two ways that expenses can be considered incurred. One is according to the passage of time. Okay, so an expense that is incurred in a particular period, such as rent or insurance, it's not going to be related to the costs of any other period. It expired in the particular period. The rent for January expired yesterday. The rent for February was paid today, February the 1st, and it will be an expense for the month of February. And the expense for March will be, it'll be paid the 1st of March or maybe the 28th or 29th of February. But it doesn't apply. The rent for March paid at the end of February does not apply to the month of February. So one of the things we're trying to do is put the expenses in the period to which they relate. This helps us get a better measure of real profitability by deducting the right expenses from the revenue that was also earned in that period. The second criteria by which we can use to recognize or record expenses is the matching principle. And this applies to expenses that basically are incurred when we sell a good or provide a service. So for example, if we are selling blue jeans, we generate revenue from the sale of blue jeans at a selling price. We need to match the cost of those jeans at the same time as the sale so that we have the most accurate measure of the gross profit from trading in goods or providing services. All right, a couple of other insights about assessing the financial performance and financial position. This was the slide that I presented at the end of chapter 1. And what we're doing here is using our analysis and assessment of business performance criteria such as growth, profits and profitability, and cash flows to answer some simple questions about the business entity's financial performance, such as, did we actually grow revenues? In other words, are we getting more customers interested in buying what we're selling? That's a good sign. That's called traction and building, penetrating a market and building our customer base. The more customers we have, the more products we can sell to them, the more revenue we'll generate, and more revenue typically results in higher levels of profit. Another question, did we generate a profit? Another one, did we generate cash flow from operations? Now, one of the reasons we have two financial statements to support the assessment of financial performance is because they measure different things. The statement of income will ultimately measure the profit we generate from providing from operating our business model and providing goods and services. But as I mentioned to you, when we talked about recognizing revenue, we recognize revenue and put it in the income statement without any regard to whether we're paid for the revenue or whether we've paid for the expenses. So that's called recognizing the transactions on an accrual basis, which means when they are earned or incurred. The statement of cash flow changes that accounting basis to the cash basis and only tracks the movement of cash. So it's highly unlikely that the net income at the bottom of the income statement and the net cash flow at the bottom of the cash flow statement, or even the net cash flow from the operating activities section, it's unlikely that the cash flows will be equal to net income, because recognizing transactions on an accrual basis without regard to the movement of cash has no comparative item in the cash flow statement. Now, when we go to evaluate financial position, we're asking questions such as this. Are we able to carry on performing? Are we sufficiently financially healthy that we can pay our debts when they come due, we can order more product, we can pay for more product, we can pay our employees, and so on? Another question that's related to that is, do we have enough in our current assets that we could convert that to an adequate amount of cash to pay our current liabilities, like accounts payable to our suppliers and salaries and wages and benefits payable to our employees? Can we pay those as and when they come due? If we are in a sufficiently good position to do that, that's called having good liquidity, okay? And lastly, a question we can ask about financial position is, do we have an appropriate mix of capital? Our capital usually has two components. There can be as many as 5, but the typical 2 are debt and equity. If we have a lot of debt, that requires an obligation to repay it on schedule with interest. And that can create, sometimes that can create problems for business entities if they don't have enough cash flow coming in to make those payments. Equity, on the other hand, usually doesn't have any fixed terms of repayment. There's no schedule to pay back the owners, so there's not as much pressure. And so one of the things that we can think about in terms of the mix of debt and equity is, if we have way too much debt, there's going to be a lot of pressure on cash flow to not be in default of making the debt payments. If we default on the payments, that can cause problems for the company in keeping its debt, keeping the cash that came with the debt. You might be asked to repay it sooner than the schedule originally provided. So the mix of debt and equity influences something called financial risk or solvency. A company is insolvent if they don't have enough resources to be able to pay their long-term liabilities as and when they come due. All right, and we did these questions in class, so that really concludes the presentation on the highlights and insights for Chapter 3.